Hi students, welcome to my channel. Our topic of discussion today is capital budgeting. Capital budgeting may be defined as the process of deciding whether to accept or reject a project on the basis of future benefits. Or put it in a simple language, is it worth put the money called capital in the project, or buying or acquiring a new business for a particular sum is a good decision considering the future inflow. Or if I buy a new machine, will it generate enough cash to justify the investment? Sometimes you may need to compare two machines and arrive at a decision which one is to buy. In all the above situations, the capital budgeting comes into play. So we can conclude that the capital budgeting is the process of making investment decision in capital expenditure. It involves the decision to invest the current fund for addition, modification, or replacement of fixed assets. Now, let us check why these capital budgeting decisions are very important, crucial, and critical to the business situations. 1. Substantial investment. To invest in a project, substantial capital is required. Because of huge capital investment, careful evaluation is required. That is, thorough study and planning is required for the investment. Second one is a long-term period. The capital budgeting or investment decisions has effect over a long period of time. It influences the pace and the direction of the growth of the firm. Third one is irreversibility. One of the crucial aspects of the capital budgeting is the irreversibility. Most of the decisions are practically and economically impossible to reverse. One bad decision may seriously affect the prospects of the company. Fourth one, it is a complex decision. Capital investment decision involves the assessment of the future cash inflows, which is very difficult to predict. Estimating the future benefit and cost with accuracy is almost impossible. That's why the capital budgeting decisions are so important. Before discussing the capital budgeting techniques, let us see the different type of capital budgeting decision to get a better insight of the subject. On the basis of firm's existence, the capital budgeting decisions can be divided into three. The first one, replacement and modernization decisions. Both these decisions are aimed at improving the operating efficiency and reducing the cost. If the change requires because of the economic life is over, it is called replacement. If the change is due to the outdated technology, it is called modernization decisions. The second type is expansion. Existing successful firms experience growth in demand. To meet this demand, they need to add more facilities for production. This is called expansion. The third type is diversification. Adding new products or new markets to the existing business is called diversification. It will reduce the risk of failure by dealing in different products or by operating in several markets. On the basis of decision situation, the capital budgeting decision can again be divided into three. The first one is mutually exclusive decisions. The acceptance of one proposal among the several alternatives will cause the rejection of all other proposals. It is called mutually exclusive decision. Example, accepting machine C will automatically reject machine A, B and D. Second one is the accept reject decision. Here the proposals are independently evaluated and accept or reject on the merit of the project. No competition with the other projects. Here all the projects may be accepted or all the projects may be rejected. Or it may happen that two projects are accepted and all the other projects are rejected. Third type is the contingent decisions. If the acceptance of a particular project will entail the acceptance of some other ancillary projects, it is called the contingent decisions. For example, if we are constructing a factory in a remote place, we may need to construct the road to that place also. Capital budgeting techniques can be divided into two: traditional or non-discounting and time adjusted or discounted cash flow. Under the traditional or non-discounting cash flows, payback period and accounting rate of return. Under the time adjusted or discounted cash flow, 1. Net present value NPV, 2. Profitability index PI, 3. Internal rate of return IRR, 4. Modified internal rate of return MIRR, 5. Discounted payback period. Capital budgeting techniques uses the cash flow and not the profit, except accounting rate of return. The reason is obvious from the name itself. Accounting rate of return uses the profit generated by the accounts. Let us start our discussion on capital budgeting with the payback period. As the name suggests, it is the length of time taken by the project to give back the money invested in it. It is very simple. Payback period can be calculated using the formula initial capital investment divided by annual after-tax net cash flow, if the cash flows are equal over the useful life of the project. A project cost rupees 10 lakhs and yield annually a profit of rupees 2 lakh after depreciation at 10% straight line, but before tax at 30%. Calculate the payback period. As I told you earlier, we need to find out the cash flow in order to find out the payback period. It is given the profit before tax PBT is equal to 2 lakhs. So we need to reduce income tax at 30% from the profit before tax, that is 60,000. So we will get profit after tax as 1,40,000. Now we need to add back the depreciation, which is a non-cash expenditure. Depreciation is 10% of 10 lakh, which is the total project cost. So the depreciation is 1 lakh. So we will get the cash flow as 1,40,000 plus 1 lakh, that is 2,40,000. We already saw the formula for the payback period is equal to initial capital investment divided by annual after tax net cash flow. So the payback period works out to be 10 lakh divided by 2.4 lakhs, which is 2.17 years or 2 years and 2 months. This means that the project will give back the money invested within 2 years and 2 months. Now, let us see how to find out the payback period when the annual net cash flows are not uniform. The cumulative cash flow from operations must be calculated for each year. The payback period shall be the corresponding period when cumulative cash inflow is equal to the initial capital investment. If exact sum does not match, then the period in which it lies should be identified. After that, we need to compute the fraction of the year that is needed to complete the payback period. A small example will help you to understand better. Let us assume the initial cash outflow is 2,10,000 and the inflows are year 1 60,000, year 2 80,000, year 3 60,000, year 4 40,000, and the cumulative cash flow 60,000, 1,40,000, 2 lakh and 2,40,000. From the above, it is clear that the payback period falls in the fourth year. Since rupees 2 lakh is recovered up to year 3, the balance rupees 10,000, that is the initial cash flow is 2,10,000. Up to third year we recovered 2 lakh, the balance is 10,000, which shall be recovered in part of the year 4, and that part we can compute by 10,000 divided by 40,000. 40,000 is the cash flow for the fourth year, so it will take only 1 by 4 of an year. So the payback period is 3 and 1 by 4 year. Decision on the basis of payback period. If the projects are mutually exclusive, that is, acceptance of one project will automatically reject all the other projects. Obviously, we will choose the project with a lesser payback period. If we follow the accept-reject criteria, we will choose all those projects with payback period less than the cutoff period. That means we would like to choose projects with less than 3-year payback period. All those projects with a less than 3 years payback period will accept, and all those projects with a payback period more than 3 years will be rejected. Now let us see what is the advantages of payback period. It is easy to compute. The computation involves only the basic mathematics and there is no complication on it. The second one is the early payback period enhance the liquidity. When the money comes back early, the liquidity of the firm will increase. Third one, easy to understand. There is no complicated formula or logic behind the calculation, so it is very easy to understand. Fourth one, works as a risk assessment as longer projects are riskier because the long-term predictions are less reliable than the short-term predictions. Now we will check what are the disadvantages of the payback period. The biggest disadvantage is it ignores the time value of money. For example, money received during the first year and the fifth year gets the same weightage. And the second one, it neglects the cash flow received after the payback period. The project with a longer payback period may have substantial cash flow after the payback period, but this does not consider in the payback period method. Third one, ignores the project's profitability. Shorter payback does not guarantee profitability. If the cash flow ends or drastically reduced after the payback period, the project might never return a profit. Fourth one, it does not consider project's return on investment. Companies require a minimum return on investment, but the payback period does not calculate the return on investment or it does not consider the return after the payback period. So it is not a foolproof method. As the name indicates, payback reciprocal is the reciprocal of payback period and founded by the formula average annual cash flow divided by initial investment. When expressed in percentage, it gives a quick estimate of the internal rate of return of an investment when the project life is more than twice the payback period and cash flows are uniform. Example, suppose a project requires an initial investment of rupees 50 lakhs and annual cash flow of rupees 10 lakh and useful life of the project is 10 years. Find the payback reciprocal. As we know, the payback reciprocal is equal to average annual cash inflow divided by initial investment. In the given problem, annual average cash inflow is equal to 10 lakhs and investment is 50 lakhs. So 10 lakh divided by 50 lakhs into 100 is equal to 20%. The second non-discounting method is accounting rate of return. Accounting rate of return is defined as the average annual net income divided by the investment. The investment can be taken either the initial investment or the average investment. Advantages of accounting rate of return. 1. This technique uses accounting information and does not require any special report. Second one, easy to calculate and simple to understand. 3. It measures the profitability of investments. Disadvantages of accounting rate of return. Accounting rate of return also ignores the time value of money. It does not consider the cash flow from the investment. Choice of accounting procedure can lead to substantially different amount of profit. Let us do a small problem. A project requiring an initial investment of rupees 5 lakhs. Profit after tax year 1 to 5 is rupees 50,000, 80,000, rupees 1,20,000, 1 lakh and 50,000. Scrap value of the plant and machinery at the end of 5 years is rupees 60,000. Find the accounting rate of return. We know the formula for finding out the accounting rate of return is average annual net income divided by investment. The investment can either be the initial investment or the average investment. The average annual net income can be found out by dividing the total profits by number of years. The initial investment is 5 lakh and the average investment is 5 lakh plus 60,000 divided by 2. So the accounting rate of return works out to be 16% or 28.57% according to the different formula. We saw the biggest disadvantage of payback period and accounting rate of return is that it ignores the time value of money. Before proceeding to the discounting technique of capital budgeting, which recognizes the time value of money, we need to understand the concept of time value of money. The concept is that money you have now is worth more than the identical sum in the future due to its potential earning capacity. This principle of finance holds good because the money can earn interest. So, any amount of money is worth more when it is received early. If the choice is in between rupees 100 today or rupees 100 a year after, there is no confusion. We will prefer to get it today. The reason being, we can put the money in the bank and earn some interest. What if the choice is in between receiving rupees 100 today and rupees 125 a year after? Most of the people at home will prefer to get rupees 125 after a year because it is very difficult to make a return of 25% if the money received now. We may decide to wait for a year and receive rupees 125 a year after. Again, what if the choice is in between rupees 100 today and rupees 110 a year after? Certainly, there may be a difference of opinion regarding this. Those who want more than 10% return or those who are confident that he can find another investment opportunity which will give him more than 10% return will prefer to accept rupees 100 today. Those who have no other investment opportunity to get up to 10% return will prefer to receive rupees 110 a year after. Third category, who can make exactly 10% elsewhere, both options, either receive rupees 100 now or rupees 110 next year, will not make any difference. When we are evaluating the project also, we face the same question. What is the desired rate of return? Theoretically, the discount rate or desired rate of return of an investment is the rate of return the firm would have earned by investing the same funds in the best available alternative investment that has the same risk. But in practical, determining the best alternative opportunity available is difficult. So, an organization may establish a minimum rate of return that all capital projects must meet. This minimum could be based on an industry average or cost of other investment opportunities. Many organizations choose to use the overall cost of capital or the weighted average cost of capital that firm is incurred in raising the funds or expected to incur in raising the funds of an investment. Decision on the project whether to accept or reject will influence by the choice of the expected return. That means a project may be feasible if the investor wants 10% return, but the same project may be rejected by another investor who wants 14% return. For a person who is expecting a return of 10%, rupees 100 today and rupees 110 a year after is having the same value. So we can say that 110 rupees a year after is the future value of 100 rupees today. Rupees 100 today is the present value of rupees 110 next year. If a person invests rupees 3 lakh in a project and he gets back a net cash inflow of rupees 1 lakh each in the next 3 years, we cannot say that he is in a no loss, no profit situation. As we discussed now, money spent and received in different time zone cannot be equated. Present value of money received in year 1, 2 and 3 are keep reducing as the year pass by. In other words, the investor needs a compensation for keeping his money invested in the business. We will continue the discussion on capital budgeting, discounting methods in the next video.